Payday loans. Payday loans are short-term loans designed to cover you until your next paycheck, usually 2 weeks out. The setup sounds simple enough. You borrow a few $100s and pay it back with your next check, plus a fee. The problem is those fees. A typical payday loan might charge $15 for every 100 you borrow, which doesn't sound terrible until you realize that works out to around 400% annual interest. Most people can't pay the full amount back when it's due, so they roll it over, paying another fee just to extend the deadline. This is where the trap closes. You end up paying fees over and over while barely touching the principal. Someone who borrows $300 might pay twice that in fees over a few months, still owing the original amount. The whole system relies on people being desperate enough to agree to terms they wouldn't accept otherwise. Credit card minimums. Here's the thing about credit card minimums. They're designed to keep you in debt as long as possible. When you charge $1,000 and only pay the minimum each month, usually around $25 or $30, you're barely touching the principal. Most of that payment goes straight to interest. The credit card company loves this because you keep paying month after month, year after year. A basic purchase, something like a laptop or a weekend trip, can take 20 years to pay off if you stick to minimums. That $1,000 ends up costing you over $2,000 by the time you're done. The math is brutal but simple. Compounding interest means you're paying interest on your interest. What started as a small convenience becomes this massive anchor dragging behind you for decades. People genuinely don't realize they're signing up for a payment plan that outlasts most car loans. Rent-to-own schemes. Rent-to-own stores let you walk out with a couch or TV today for something like $15 a week, which sounds manageable when you're broke and sitting on a bare floor. The catch is you're signing up for payments that stretch 18 months or longer, and by the time you actually own that couch, you've paid 3 or 4 times what it cost at a regular store. A $500 television ends up costing $2,000. The companies target neighborhoods where people don't have credit cards or savings for a furniture store's financing plans. You need a bed or a fridge right now, not next month when you've saved up, so the weekly payment feels like the only option. Most contracts are structured, so missing even one payment means they repossess everything and you lose all the money you already put in. You're essentially paying luxury prices for basic necessities, one small installment at a time, because you couldn't afford to pay normal prices up front. Overdraft fees. Overdraft fees are maybe the most efficient way banks have figured out to extract money from people who don't have much to begin with. Here's how it works. You've got $20 in your account and you buy a coffee for $4, then lunch for $12, then gas for $30. Your account goes negative on that gas purchase, so the bank hits you with a $35 fee. But here's the thing. Banks often process the largest transaction first, which means in this scenario they might charge you 3 separate overdraft fees, one for each purchase, because technically all 3 went through on the same day. You wake up the next morning owing $105 in fees on $46 worth of purchases. The people this hits hardest are exactly the ones living closest to zero, where a few dollars either way actually matters. Title loans. A title loan works like this. You own your car outright, you need cash fast, and you hand over the title as collateral. The lender gives you maybe 25 to 50% of what the car is actually worth. You keep driving it, but they legally own it until you pay back the loan. The catch is the interest rate, which typically runs between 200 and 300% APR, sometimes higher. Most of these loans are structured as 30-day terms. If you borrowed $800, you might owe $1,000 by the end of the month. Miss that payment, and the fees compound fast. The real trap is that if you default, they repossess the car. For most borrowers, losing the vehicle means losing their way to get to work, which means losing income, which makes it impossible to dig out. It's a particularly vicious cycle because the thing you're risking is often the only thing keeping you employed. Subprime auto financing. Subprime auto loans target people with bad credit scores who can't qualify for normal financing. The interest rates typically run between 15 and 25%, which sounds bad enough, but it gets worse. Dealerships that specialize in this often mark up the cars themselves by thousands of dollars above market value. You might think you're buying a $10,000 used sedan, but the dealer prices it at $15,000 before you even start paying interest. The moment you drive off the lot, you're underwater on the loan, meaning you owe more than the car is worth. If anything goes wrong and you need to sell or trade it in, You're stuck with debt even after the car is gone. Some dealers also load these contracts with extra fees and products you didn't ask for, buried in the paperwork. The whole system banks on you either not reading carefully or having no other options. Buy now, pay later. Buy now, pay later services look harmless at first because they split your purchase into 4 equal payments with no interest if you pay on time, which sounds way better than a credit card. The catch is how easy they make it to say yes to things you probably shouldn't buy right now. You're shopping online, you see something you want, and instead of thinking about whether you can afford $60, you're just thinking about 4 payments of 15. That mental shift is the entire business model. The real trouble starts when you use 3 or 4 of these services at once, because you've got overlapping payment schedules hitting your bank account every few days. Miss one and you're looking at late fees that can run $25 to $35, plus some of them will report you to credit bureaus. People treat these like they're not real debt, but your bank account doesn't care about the psychology. Lottery and gambling. Most state lotteries operate on the same basic principle. They take in way more money than they pay out, with odds so bad that buying a ticket is mathematically one of the worst financial decisions you can make. The typical big jackpot lottery has odds around 1 in several hundred million, which means you're more likely to be struck by lightning multiple times than to win. What makes this particularly effective is how it's marketed. Billboards in low-income neighborhoods showing giant checks and slogans about dreams coming true, making it feel like a legitimate strategy, rather than essentially throwing money away. The lottery pulls in billions every year, with lower-income players spending a much higher percentage of their income on tickets. Casinos and scratch-offs work the same way, using variable rewards and near misses to keep people playing, despite consistent losses. The house always wins because the math guarantees it. Multi-level marketing. Multi-level marketing works by convincing you to buy a starter kit of products, usually for a few $100s, then telling you the real money comes from recruiting others to do the same. You're not really selling leggings or essential oils or whatever, you're selling the business opportunity itself. The person who recruited you gets a cut of what you spend, and their recruiter gets a cut of that, creating a pyramid where money flows upward. The math is brutal. Since everyone's trying to recruit in the same limited social circles, the market saturates almost immediately. Studies show 99% of people in MLMs lose money when you factor in the inventory they're stuck with and the hours they spent. But the pitch is always about freedom, working from home, being your own boss. They target stay-at-home parents and people desperate for extra income, the exact people who can least afford to lose that initial investment. The few success stories you hear about are almost always the early adopters. Debt settlement scams. Debt settlement companies pitch themselves as saviors when you're drowning in credit card bills or medical debt, but the pitch is almost always misleading. Here's how it works. They tell you to stop paying your creditors entirely and instead send monthly payments to them, claiming they'll negotiate your debt down to pennies on the dollar. While you're doing this, your credit score is tanking because you're missing payments. Late fees and interest are piling up, and collection agencies are calling non-stop. The company holds your money in an account and maybe, after months or even years, attempts to settle one debt. By then, you owe more than when you started, your credit is destroyed, and the settlement they get, if any, barely covers the fees they've already charged you. Most people would have been better off just working directly with creditors or filing bankruptcy, but the companies don't mention those options because there's no profit in it for them. In for-profit colleges. For-profit colleges operate as businesses first and educational institutions second, which means their main goal is maximizing enrollment rather than graduate outcomes. They spend heavily on advertising and recruiting, often targeting low-income students, veterans, and working adults who qualify for federal financial aid. The pitch is simple: flexible schedules, career-focused training, and help with loans. What most students don't realize until it's too late is that the degree they're paying $50,000 or $60,000 for carries almost no weight with employers. Many companies specifically filter out graduates from certain for-profit schools when reviewing applications. Meanwhile, the school already got paid through federal loans that the student is now responsible for repaying. Graduation rates at these places tend to hover around 30%, But even the ones who finish often end up in default within a few years because the jobs they were promised either don't exist or pay far less than what's needed to cover the debt. Subscription creep. The numbers trick you because they're designed that way. You see $9.99 a month and think it's manageable, maybe even cheap. But then you sign up for another one, and suddenly you've got 6 or 7 services running at once. Most people don't add them up until they actually sit down and check their bank statements, which they never do. A streaming service here, a productivity app there, that meditation thing you use twice, the news site you meant to read more often. Each one is just 10 or 12 bucks, but together they're pulling $200 out of your account every single month. That's $2,400 a year, gone before you even notice. The free trials make it worse because they auto-convert to paid subscriptions, and the cancellation process is usually buried 3 menus deep. Some companies even make you call to cancel, hoping you'll just give up and keep paying. Lifestyle inflation. Lifestyle inflation is what happens when your spending automatically grows to match your income. So you never actually get ahead. You get a raise, and within months you've upgraded your apartment, leased a nicer car, started eating out more often, maybe subscribed to a few more services you don't really need. The extra money just disappears into a slightly fancier version of your life. The problem is, you're now locked into higher fixed costs. That new apartment costs more every month. The car payment is higher. Your baseline expenses have permanently increased, so if anything goes wrong, you're actually more vulnerable than before. People do this unconsciously because it feels like you deserve nicer things when you earn more, which is fair enough, but it creates a treadmill where no amount of income ever translates into actual financial security. You're always spending exactly what you make, just at a higher tier. Medical debt spiral. Medical debt works differently than other debt because you usually can't plan for it and you can't shop around when you're bleeding. Here's what actually happens. You go to the emergency room with chest pain. The hospital is in-network, but the ER doctor treating you isn't, so his bill hits you separately at full price. That's surprise billing. Your insurance covers 80% after deductible, which sounds reasonable until the bill comes to $60,000 and your share is $12,000. Most people don't have that sitting around, so the hospital offers a payment plan at 9% interest. You're paying $300 a month, but it's mostly interest, so the principal barely moves. Meanwhile, you need follow-up care, which generates more bills. Each appointment adds to the pile. Within a year, you're $20,000 in, collection agencies start calling, and bankruptcy becomes the only way out. About half of all personal bankruptcies in America involve medical debt. Having insurance doesn't protect you from this.